There are other reasons for why principal component analysis, when it was first used in the industry, and it was used again, 50 years ago, so we're still, relatively far in the past, it was refuted. It was applied to both individual stocks and portfolios, and it worked absolutely miserably on them. One other reason why that is happening is not just because principal components, they disregard information in expected returns on the securities, but also that they assume a lot of the very strong assumptions about the data generating process. One of them being constant loadings. So principal components usually assume that we're going to have this constant exposure to the underlying risk factors. And especially if you deal with individual stocks, that is simply not true. Individual companies, they change their business. They grow, they mature, they become bankrupt, they have different growth opportunities at different parts of their life cycle, so they have different exposure to systematic risk. As a result, it is something that ideally you want your model to explicitly take into account and model it. Either through the models with latent factors that have been developed in financial econometrics area recently, or through the models that have been developed with the machine learning aspect, of course. So for example, deep neural networks are particularly useful in this aspect. But there is one relatively simple trick that you can use to already help principal components quite a bit when we talk about factor extraction in the return space. And that is to go back to that other half of the decision making and the objective function in finance. That is to look at the trade-off between the variance and the expected rate of return. So what you see here is the modification of the principal component analysis that tries to achieve exactly that. How does it work? Well, on the left-hand side of the equation, you have our usual, objective part, which says that we want to look for factors that are going to be minimizing, the overall variance, right? But there is a second term. The second term tells me that the factors are going to be such that expected return on my securities are going to be lining up with the risk premia on those factors. That is, R bar is equal to my average factor, since that's a tradable version. It's a linear combination of the underlying securities, F bar, multiplied by lambda. This is basically a PCA version of the CAPM. Because if the CAPM model was true, then we would expect that all of the excess return on the stocks are going to be lining up equal to beta multiplied by the market premia, right? So in the latent factor space, the analog of this dependency is going to look like R bar is equal to F bar multiplied by lambda. Yeah? So why is this something that is going to work? Because effectively what it does, it boosts up the signal of the weak principal components that are very important to explain a cross-section of average returns. Among a wide set of securities and portfolios, we have a lot of the assets that have high rate of return, low rate of return. There is a very big spread between them. So that means that if we want to capture that spread, we want to get the factors that directly correspond to that exposure. And if those factors correspond to the cross-sectional exposure of the stocks, these are the ones that are going to carry risk premia. These are the ones that are going to give me a high risk return trade-off. And these are the ones that are going to be much more useful in empirical finance and investment strategies. So this is the idea behind the approach of the so-called risk premia PCA that have been recently suggested, and it actually turned out to work remarkably well on a wide set of cross-sectional assets. So the factors that you get from this approach, they also tend to have higher Sharpe ratios, they tend to have lower turnover, and they also tend to, in general, help to explain a lot of those, 300 or 600 strategies that we have seen before in a also much more consistent way.